It really started when we all joined together as a team back in 2021 here at Brown. And we sat down and thought about all the different types of strategies that we could manage for our clients. A lot of that thought process really was driven by what our clients needed from us. And so we thought about not only Brown Advisory's private clients, but the institutional marketplace. And what we recognized was that there were two missing pieces for investors in fixed income. One was to really have a go-anywhere, unconstrained strategic bond fund that could be really dynamic and really flexible, to take advantage of market opportunities, but to deliver the downside capture that I think investors had really struggled to find in the strategic bond space. The second, though, was to be able to deliver a sustainable bond strategy. When we looked at the marketplace, it felt very underserved. And so we took all the different strategies that we had managed in the past and tried to really bring out the best of all of them. That one could really capture the upside in the marketplace, but really importantly, be able to protect in challenging markets, which we've been very pleased to have been able to deliver since we launched the strategy. And certainly the 3 years since then have been very interesting. We have been faced with a fixed income marketplace that has had to deal with inflation. We've had to deal with rates moving from 0 all the way up to 5% in some parts of the world and higher. And in a way, it was actually a great time to launch this strategy. When we talk about what the strategy can deliver for our clients, being able to navigate the challenging markets, in our view, is really the most important part. And so it has been difficult, but to be able to really show proof of concept in terms of what we can deliver for clients in a year like 2022, I think has really worked for us. There is a reality that the world that we're in now is very different from the world that we had been in pre-COVID, pre the GFC. And so, we're focused on really utilizing the dynamic nature of this strategy to navigate what we think will be very challenging and very interesting markets going forward. Our view is that cycles shift, and you have, in a traditional economic cycle, different phases that you have to take advantage of. When we think about the growth phase of an economic cycle, you typically would have more credit risk. You might have less interest rate risk in the strategy. As you get over into the slowdown phases or recessionary periods, it's thinking about how do you protect capital for clients, more interest rate risk in the portfolio, less credit risk in the portfolio. And so from our perspective, that flexibility is really important. Taking a high-level view of the macro landscape, identifying the opportunities, identifying valuations, but really incorporating, the bottom-up research that we do at the company level to give us different insights in terms of the cycle, so that we can be differentiated, that we can have additional lenses to view risk and to understand risk from the top down, that can allow us to identify inflection points, but really importantly, to position portfolios where we think the world is going to be. There's a reality that in fixed income, markets have become less and less liquid over time. That you have to really think about where the world is going to be in 6 and 12 months' time to position your portfolio in order to not just deliver the upside capture that we talk about, but really be thoughtful about the slowdown periods where we can really differentiate ourselves and act as the counterbalance or the counterweight to the equity risks and other risks in our clients' asset allocation portfolios. Sustainability is a really important lens that we can use to understand governance risk, social risk, and environmental risk. And what we're finding is that those risks are becoming increasingly economic in terms of how bonds perform. And so, for us to be able to use any lens to understand risk and return better is important. And sustainability is what we're finding is that it's becoming more economic. It's becoming embedded and has been embedded in our research process. And our view is that these last 3 years are actually much more representative and reflective of a normalized market environment. And we lived through a world post the GFC where there was very little volatility. Rates were incredibly low, credit spreads are incredibly tight, and I think market participants got a little bit relaxed about risks that could be embedded in the global economy. One of the things that we think really differentiates us in our investment process is the integration of both top-down and bottom-up research. As a global fixed income strategy, the top-down is really relevant and important in terms of how we think about taking risk and positioning the portfolio. And so we look at a lot of the traditional top-down factors in order to really get a sense of where we are in the global economy. But the bottom-up is really important in terms of the information it can give us to really have a nuanced and differentiated view of the top-down. And for example, in early 22, when we launched the strategy, we were living in a world where a lot of people thought that inflation was transitory. And we spent a lot of time with our analysts, especially on the consumer side, really trying to understand businesses and talking to management teams to talk about the labor markets and whether they were able to hire people or not. And what we're hearing from almost every company that we spoke to was that the labor market was incredibly tight and that they were very concerned about, especially post-COVID, with having to hoard labor and to pay their employees. So wages were going higher. There was a sort of cycle that was happening in terms of tight labor markets passing through to inflation. That was actually quite differentiated, and you weren't really seeing it in the top-down data necessarily. Central bankers were telling you that inflation's transitory, nothing to worry about. It was the bottom up that was really giving us a signal that there was risks in fixed income, especially on the interest rate side, which is why we had very little duration in the portfolio. And we're very sort of focused on protecting capital as rates were moving higher to get on top of what ended up being very sticky inflation around the world. There's some nuance to delivering risk-adjusted returns. Our view has always been that if we can do a better job of navigating the challenging markets and to have less drawdowns in the portfolio, but still having all the tools that we need in order to participate when markets are doing well, that over the course of an economic cycle, we can deliver better risk-adjusted returns. And that's one of the things that we're very proud of as a team. And we look at our long-term absolute and relative returns, and they've been good, but what we really focus on are the risk-adjusted returns. How much return can we provide for our clients, a smoother ride for our clients over the course of an economic cycle over 5 to 7 years. The second is the role that a bond fund is meant to play in a client's portfolio. And ultimately, fixed income is meant to be a stability asset. And so when we think about how we position portfolios, the thing that we really have to get right is how do we act as the counterbalance or the counterweight to equity risk and other risks in clients' portfolios. There are times in the economic cycle where it's perfectly fine and we are very willing to be positively correlated to equities, when economies are growing and you have attractive valuations. But the really important part is when markets are more challenging. That willingness to really shift your portfolio to a place that's more defensive, to act as that counterbalance, is a really important part of being a core allocation for our clients. And the third is on the sustainability front. For clients that are looking to allocate their capital to sustainable strategies, it's the research that we do on the investments that we make that we believe can help to solve environmental, social, and governance challenges that are faced in the world. Our view of the world going forward is that we're now transitioning back to what the world used to look like pre the GFC. That we're going to have periods of inflation. We're going to have periods of central banks needing to hike rates to get on top of inflation, which can cause recessions to be much more dynamic, to be much more volatile. And in a way, this is a perfect environment for active strategies. The ability to be really dynamic and flexible. That's the world we think that we're heading into. It is a world that will be with opportunities. It's a world that will be with challenges. But we think that our approach and our philosophy is really well suited to navigating the world ahead.